Welcome back everyone to the Money Control live stream. It looks like Dalal Street has almost braved the Fed storm as investors continue to climb the wall of worry when it comes to inflation and rate hikes. If you look at the Nifty and Sensex, they are considerably off their day's low at this point of time, helped in large parts by what is happening in the US futures market. The US futures market rallied quite sharply and in fact turned into the positive territory at this point of time as we speak, clearly indicating that we could have a very good start when the US markets open later in the evening, Santo. But the key market today, or the biggest story right now globally, is the forex market or the foreign currency market. The rupee sank to a record low against the US dollar today. If you look at the yen, yen rallied almost 200 pips or 200 units against the US dollar after news broke that the Bank of Japan has finally intervened in the yen dollar market for the first time since 1998. And then you look at the Chinese yuan. The Chinese yuan is now sitting at 7.1, levels that were probably not thought of a couple of months ago, in fact. So clearly, at this point of time, the volatility in the forex market is quite huge. But as far as the equity investors are concerned, it's Christmas time.
Well, CJ, I think at this point in time, the equity investors are just focusing. It's a single-minded focus only on equities, and they're just oblivious to what is happening in the rest of the world. Now, rupee.
Come on, Santo. They are not that horse visioned that they don't.
Clearly, tunnel vision, CJ. Now, the strengthening, the appreciation in yuan could spell bad news for FI flows, because a lot of carry trades happen when the yuan is weak. The way it works is this. You borrow in yuan where the interest rates are low and the currency is weak, convert it into dollars, and then put it back into emerging market equities. But when the yuan starts appreciating, then the profit margins narrow, and this is also a time when returns from equities have somewhat moderated. If you look at it from a 6 to 8 month perspective, and that's the reason why probably when the yuan appreciates, you could then see a sudden rush for the exit. We had last seen it, I think, in October 2008. That was a month when you had really bloodbath out there. And while the situation doesn't look as dire at this point in time, because there's been no pile up by FIs till now. In fact, they've been more active on the selling side. But globally, there is every possibility that a lot of money that has gone into risk assets could be through carry trade. So that is something clearly one needs to watch out for.
I think, Santo, I was at the BNP Paribas event, prior to coming here, and their view is right now that they are quite cautious on the Indian market looking a year ahead, largely because of two factors. A, valuations, because you can decouple from the global markets, but valuations can't decouple from equity markets. And clearly, valuation will remain important going ahead. At this point of time, India is probably the most expensive market out there in the world. So clearly, that is one concern. And secondly, if you look at the difference between the bond yield and the earnings yield at this point of time, that is in excess of 200 basis points. Generally, in the past, say 2008, 2014, 2018, whenever that sort of a scenario has happened, equities have tend to give negative returns in the following 12 months. So a word of caution coming out from big foreign brokerage like BNP Paribas. But I think overall, if you look at today's action, that will probably give a lot of heart to the bulls. And I was, when we were prepping for the show earlier in the morning, I had a feeling that you could see some bit of comeback in the market, given that optimism at this point of time seems just too strong.
Yeah, I think every rebound at this point in time is attracting more fence sitters.
Yes, exactly.
That is one. And secondly, you mentioned about high, lofty valuations. And given the flow of liquidity that we are seeing in the market at this point in time, probably valuations could stay elevated for some more time.
Well, we'll have to see how long that liquidity lasts, Santo, with the Fed tapering almost $95 billion a month now. Almost $1 trillion will be taken out of the global market over the next 12 months. So clearly, we will have to wait and watch whether this liquidity binge that Indian markets are enjoying will sustain or not.
Well, with that said, let's quickly dive into the stocks on our watch list this afternoon, starting with SBI Cards. CJ, the stock had seen a good rebound.
Almost a 30% rally in the
after
past
its first quarter. Probably the pessimism was overdone, but again now the stock has given up quite a bit of its gains over the last few trading sessions, and reasons are not really hard to find. This is a good business, no doubt, but suddenly you have multiple headwinds facing it at this point in time. The biggest one being the RBI stance on merchant discount rate and what and what stance it will eventually take. Now, there is a feeling that probably it might not be very harsh, but that said, there are other factors at play also. One is that rates are rising, and when typically rates rise, you don't have too many people carrying forward their credit card outstanding, which is called the revolver book, and which is the high earning portion for credit card companies like SBI. Of course, now competition is a part and parcel of every industry, but there are some other structural changes are also happening in the credit card industry, and one of them being the rise of the BNPL culture, which is clearly a threat for a company like SBI. And that apart, a lot of people now are converting their lump sum purchases into EMIs. Now, credit card companies do earn, but the earning is much lower than what they would otherwise earn if they had been carrying forward. On the good part, SBI Cards has managed to improve its asset quality. There is no disputing that, but there are far too many negatives at this point in time. Remember, SBI Card itself is after the pandemic, what it tried to do was shift focus more to its regular book, reduce in fact its dependence on the revolver book, and look for higher income through what's known as the spend fees, which is what it charges its consumers when they use the card. So, given all these factors, probably the run up in SBI Card is now over, and you could see the stock probably underperforming a bit near term.
Well, Santo, I hate to disagree with you, but I feel that probably if you look at it from a bit away from the near-term headwinds, I think there is still a good story out there at SBI Cards. Clearly, the company has made a good comeback ever since we have seen the reopening of the economy, and you can see that in the credit spends data that we have been seeing, over the past few months. The momentum as far as credit card spend is concerned is quite strong, and SBI has been among the leaders. SBI Cards has been among the leaders when it comes to card spends or consumer card spends. So clearly, I think demand is still quite high. Yes, credit card additions, if you look at it on a year-on-year basis, has not been that great. But if you look at it from a sequential point of view, there has been considerable improvement or momentum as far as addition of credit card users is also concerned. And overall, with the festive season coming in, I think, Santo, this is usually would be the the time when you will see a lot of credit card transaction happening, because people are purchasing white goods, people are purchasing jewelry, they are spending money on home improvement. So I think a lot of momentum in credit card spends is likely to come ahead in the coming months, and I think therefore I will still stay quite optimistic, given that credit cards is still quite an under-penetrated market, even at a metro level, not even considering the tier 2 and tier 3 cities at this point.
Those are the people who are moving to BNPL, CJ.
I don't know whether BNPL, yes, it's a new kid in the block.
And it is a favorite with the millennials. Let me tell you that in case you have not noticed.
I know, I understand.
Have you tried BNPL?
No, not really. Not really, never.
Okay. You're an outlier then. Probably you are not the target audience.
That is true. I mean, it is, I think, about convenience, Santo. And as far as credit card users are concerned, I think probably once it becomes even more convenient to use credit cards, I think you will see that it will be able to compete with BNPL probably at an even footing. That said, yes, the MDR issues is something that will hang as a sword on top of credit card companies going ahead. We will have to wait and see what sort of guidance the RBI comes out, or what sort of guidelines the RBI comes out on as far as the MDR is concerned. But I think if you look at the brokerage commentary after that paper came out, most of the brokerage did not fear too much of a negative impact on MDR, and I think that is probably something that the market will also take into account going ahead. Well, the next stock on my radar today is probably one of the biggest losers of the day from the IT space, Infosys. The stock hit a 16-month low today, but I'm going to be a contrarian here, Santo, and I feel that the long-term story for Infosys still remains quite intact, and not only for Infosys but the larger IT pack. If you at the BNP event, they were talking about some of the recent surveys they have done with CEOs, and the most important takeaway from that was that CEOs, even though they do expect a slowdown in US economy and possibly a recession, they do not expect to slow down on capital investments going ahead, and that is largely because tech spending has become a revenue generator. It's no longer an enabler. It's no longer a side a side business for them. It actually adds to their revenue growth, and that is why they do not want to take away the 5 or 10 year vision as far as tech spending is concerned, just because the economy could be in a recession for a couple of quarters. Also, the expectation among US CEOs so far is that there could be a recession, yes, But it is not because of a financial crisis. It's not because of a systemic crisis. It's not going to be a global financial crisis sort of a situation. And therefore, there is no need to shut down everything. You don't need to cut down on IT spending or tech spending. In fact, they expect that it is going to be an artificial recession, and therefore there is a path to recovery that automatically is there, and therefore they do not need to curtail on tech spending going ahead. And I think the other point that BNP made is that Indian companies in particular, although the revenue pie may not be growing at this point of time because of the slowdown fears, Indian companies are gaining substantial market share from some of their foreign rivals at this point of time, and that also bodes well for the top line of a company like Infosys Santo.
Well, allow me to go back a little in time, CJ. In 2000, when tech companies were the toast of the market, toast as in they were being chased by fund managers and traders alike. At that time also, the argument given was very similar. Come what may, foreign companies are unlikely to cut back on their tech spending, and this is where it's going to be like heady days of wine and roses for IT companies in perpetuity, and things didn't quite play out that way. Now, in this case here, what we are seeing is there is not so much a threat to the companies, IT companies' earnings in FY23. That much is very evident, and if you see the commentary from all CEOs of IT services companies, that much is very evident that FY23 is clearly now. Where I think the market is worried, and that is what they are trying to price in, is what happens beyond FY23. That's a bit of uncertainty out there, and again, when we see that IT companies are not really going out of their way to woo talent, right? It means that the war for talent has abated somewhat, and the hirings have clearly moderated. All that goes to show that probably the demand now last couple of years were clearly an outlier. You can't have that kind of strong demand. Over the long term, yes, I take your point, CJ. Clearly, these stocks will continue to do well, but it's the near term which is probably giving jitters to the market, and what you're seeing in the prices.
Yeah, I think you will probably, if you're a holder of Infosys, you will probably have to look past the near term and believe in the longer term story if you really want to hold on to it. Because while growth might moderate, I don't think it's going away altogether. I think we are not going back to the 2012-2016 period when growth had considerably slowed down for IT companies.
Well, next stock, GNFC. Now, this company is expected to be a big beneficiary of the government's decision to continue the anti-dumping duty on toluene deisocyanate, which is one of the major products of GNFC, and this is also a company where you're seeing fair bit of institutional interest. In fact, the institutional holdings in the company have been steadily inching up over the last 4 quarters, and this is, while the name has fertilizer in it, it's more of a chemicals play, and that accounts for close to about 67% of its revenues. This is a stock to keep an eye out for, CJ.
Clearly, Santo, I think largely, of course, the entire chemical space is something that you should probably keep an eye out on, and GNFC recently has been making a lot of good moves as far as the stock is concerned. There is a decent amount of volume and price gain on the stock, and I think given that the anti-dumping duty is has continued, that provides certainty or revenue visibility for another 3 to 5 years for the company, and that is something that the market will definitely appreciate going ahead. Well, the last stock on my radar today is from the consumer durable space, and this is Whirlpool of India. Again, a contrarian bet on what is happening at this point of time in the sector. Yes, the sector has not performed that well in 2021, Santo, because there were concerns about margins, because of higher raw material prices. People were a little worried that a lot of white goods are purchased on EMIs, and of course Bajaj Finance has made a business out of that. But because of higher interest rate, whether people will go and consume those sort of products anymore, and of course in generally inflationary environment, people tend to cut back on purchase, high ticket item purchase, and whether that could affect demand as well. So there have been a lot of concerns, but if you look at Whirlpool India, the view right now is that the next 6 months or 7 months could see a little bit of gains in the stock, largely driven by improvements in margins. Because if you look at it from a sequential point of view, raw material prices have come down quite considerably. We know that globally commodity prices have come down quite considerably, and because margins are a cyclical story as far as consumer durables are concerned, we are already sitting at almost 10-year lows of margin as far as the consumer durable space is concerned, and therefore there is a good argument to be made that margins are going to improve henceforth. But if you look at FY24, I think that's when the demand side of the story will come into picture, Santo, and that is the belief that BNP Paribas has at this point of time. They believe that in FY24 you could see a strong demand-led growth in the top line of Whirlpool India. Apart from that, of course, all said and done is the festive season that will provide a litmus test to us whether the demand environment is recovering or whether it is getting worse and worse.
Well, for a company that commands a fairly high multiple, now before I get to that, CJ, this has been a good performer for someone who managed to get into the stock somewhere in 2013 because it became a 10-bagger in less than in just about 7 years, less than 7 years.
I think prior to 2021,
it had a heady run between 2014 and 2021. So investors who have held on to the stock for long have nothing to complain. It's just the near term that's looking a little uncertain at this point in time because margins have been erratic for quite some time now. If you look at for many quarters, there is just no consistency. Profitability clearly has been an issue because of that, barring one quarter where a big component came through the other income, which is sometime in December 2021. The performance has been nothing much to really write home about. So unless investors can see, and that's again reflected in the way market has been treating the stock. It's been
considerably,
it's been one of the biggest underperformers. Now that said, unless the market is convinced that there is some change, you're seeing some bit of improvement. Typically these things tend to happen in advance. Market already spots it even before the improvement comes, and that's something we are not seeing right now. At least I can't sense it the way the price has been
that's why I said it's a contrarian bet. I think market is not probably sensing it, but I think probably September quarter.
CJ here is sensing it. That's
September
what I feel.
Quarter commentary, I think Santo will be the crucial indicator. If the management indicates that yes, we have seen the worst of the margin pressure and therefore we see some improvement, I think this is one stock that could be up for a little bit of re-rating going ahead.
Well, last stock on our watch list this afternoon is City Union Bank. Overall bank stocks have been under pressure today, although they have managed to trim most of their losses. Now with City Union Bank, the case is the argument in favor of the stock is quite simple. It's expected to grow its loan book by about 15 to 18%. That's what the management is saying. That is for this year. Besides, 90% of its book is largely linked to floating rates, which means that the bank, like many others, will do well in a floating rate environment. It is increased. It largely caters to the mid market, and the management is hopeful that in the second half of FY23, this segment should do really well. Brokerage house MK expects the return on asset to improve from about 1.3% in FY22 to about 1.6% over the next couple of years. It has a buy rating on the stock with a price target of 200 rupees.
I think, Santo, if you look at City Union Bank, of course, at this point of time, it seems like a very good story. But my general point of view around the banking names is that I think it's the bigger banks which are going to run away with the biggest gains in the coming, whatever you call it, the credit cycle, as a lot of people have been calling it. I think that is largely down to the fact that the banks or lenders who have the ability to mobilize funds or deposits will end up being the biggest winners. And if you look at City Union, I think given its size, I don't think it has that liability franchise at this point of time to compete with an ICICI Bank or an SBI as far as deposit mobilization concerned. And because you cannot mobilize those deposit, therefore you will not be able to take advantage of the credit opportunity that is out there in the market. Also, if you look at the net interest side, yes, they do have a higher proportion of floating rate exchanges, and because of the the link to MCLR and EBLR, especially the EBLR, everybody is expecting that net interest margin is going to improve. But look at it this way: that if the deposit growth is probably moderate, and then they have to borrow a lot in a high interest rate environment, then your cost of borrowing definitely goes up. But along with that, within the floating rate, loan, Santo, almost 40 to 50% are corporate loans. Now, corporate, given the fact that MCLR tends to not move as fast as the EBLR, if you're a corporate house, why would you want to borrow at EBLR when the MCLR is lower? And I think that is where there is a risk with the banking sector that NIMs actually could come into pressure once we see, we see out the entire interest rate hiking cycle from the RBI.
Well, with that, a quick...
Although, Santo, before we move on, I think we need to issue one clarification. So, the carry trade that you were mentioning, Santo, I think you wanted to say yen instead of yuan. I think you ended up accidentally saying yuan. So, it was the yen. I think he's referring to yen and not the yuan.
Was it pointed by some...
Yes, Neeraj Jain, one of our viewers, had pointed it out.
Well, thank you, Neeraj, for pointing it out. It was rather a slip of the tongue, I would say.
Absolutely. So, that said, let's quickly take a look at the market. I think, I mean, 0.5% down. So, clearly, we managed to cut half of the losses, but not all of them. We were threatening to end the session in the green, Santo, but clearly it is going to be a red day in the market. But I think what the market will take heart from is the mid-cap space and small-cap space, Santo. If you look at the Nifty mid-cap on your, it's in fact, it's higher by 0.4%. I think I got shocked that the Nifty mid-cap 100 was down about 0.7%. But I think at this point of time, the Nifty mid-cap and the Nifty small-cap probably are doing quite well.
The rally in the mid cap probably reminds me of that saying, the second part of it, which is where angels fear to tread.
Clearly, Santo. And I think if we can bring up the chart of the India VIX, I think it'll be very interesting to see what the volatility index is doing. And clearly you can see it there. I mean, on a day like today, when almost every asset class is so volatile, from the bond market to the currency market, the India VIX is actually down 2.6%, Santo. And I think that there is the story.
Okay. Well, and what are we keeping an eye out? Well, before that, let's quickly have a quick look at the rupee. It's still at 80.28, is it? Or
80.28, almost 80.28.
And that's been the other big story of
I mean, we have come off the day's low. We hit a record low, I think around 80.60 if I'm not wrong.
So 80.7, I think.
Yeah, 80.7. I think we moved on to 80.7. But from there, we have come off a little bit from the day's low. But clearly, rupee, there is a view now that we may be inching towards the 81 and maybe perhaps the 82 level.
Dramatic turnaround in the last few days. Just when you thought that your sustained FI flows could probably change the story, and you could see the
Santo, why there is a probably turnaround is the fact that the banking system, liquidity level has turned into deficit yesterday, and that means that probably RBI somehow or somewhere would need to taper on its forex interventions, because that was also contributing to the drying up of liquidity as far as the banking system is concerned. So clearly, I think there is a lot happening in the money market and in the forex market, and the RBI policy coming up would be a very, very interesting one.
And what do we have to keep an eye out for?
Well, Santo, not much. I think a lot of central banking action is happening today. Of course, you have the BOE as well as the ECB probably coming out with their monetary policy outcome later today. You have the BOJ coming out with the monetary policy outcome earlier in the day. In the evening, you will have the weekly initial jobless data claims that come out in the US. So that will be another key data point to track as far as the job market is concerned in the US. And largely, it's a more moderate day tomorrow. Not much on the economic front at this point of time.
Well, thank you. And with that, it's a wrap on this edition of Market with Santo and CJ. Thanks for watching, and please do post your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again tomorrow morning at 9 a.m. Till then, have a great day.